Hello everyone, welcome to week 9 lecture videos. Our today's topic is sources of corporate financing. We'll be covering two chapters today, chapter 14 and chapter 15, and we start with chapter 14 first, an overview of corporate financing. As usual, we have few learning objectives today. We start this chapter by looking at aggregate data on sources of financing. So we will be basically talking about the pattern of corporate financing. We will see that much of the money for new investments comes from profit that companies retain and reinvest. The remainder comes from selling new securities, debt, or equity. These financing patterns raise several interesting questions. Do companies rely too heavily on internal financing rather than on new issues of debt or equity? Are debt ratios of US corporations dangerously high? How do patterns of financing differ across the major industrialized countries? Our second task in this chapter will be to review some of the essential features of debt and equity. Lenders and stockholders have different cash flow rights and different control rights. We will see that lenders have first claim on cash flow because they are promised definite cash payments for interest and principal. The stockholders receive whatever cash is left over after the lenders are paid. The stockholders, on the other hand, have complete control over the firm, providing that they keep their promises to lenders. As owners of the business, stockholders have ultimate control over the assets of the company, how the assets are financed, and how they are used. Of course, in large public corporations, the stockholders delegate these decisions to the board of directors, who in turn appoint senior management. In these cases, effective control often ends up with company's management. And last of all, we will talk about financial markets and institutions and their role. So first of all is patterns of corporate financing. As I have already indicated, that firms primarily tend to use their own fund to make investment in capital projects, and if that fund is not sufficient, then they go to raise additional funds by issuing securities, for example, bonds and stocks. This graph shows where US companies get the cash to pay for these investments. Most of the cash is generated internally. You can see that internal generated fund is indicated by these blue bars. So you can see that most of the funds are coming from this internally generated fund. So you understand that it comes from the cash allocated to depreciation and from retained earnings. Shareholders are happy to plow this cash back into the firm, provided that the investment that is made by internally generated fund have a positive NPV. Every positive NPV outlays increase shareholders' value. You need to understand that US corporations are not alone in relying mostly on internally generated cash. For example, internal cash flow makes up more than 2/3 of corporate financing in Germany, Japan, and the UK. Some internal cash flows more than sometimes internal cash flows are more than covers investment. More often it does not, and the company faces a financial deficit. To cover the deficit, the company must cut back on dividends in order to increase retained earnings, or it must raise new debt or equity capital from outside investors. So there are two basic financing decisions. The first financing decision is what fraction of profits should be plowed back into the business rather than paid out to shareholders. And the second decision is what fraction of the financial deficit should be met with debt rather than equities. Thus, the firm needs a payout policy that we will be discussing in chapter 16 and a debt policy that we will be discussing in chapter 17 and 18. So take a look at the US equity issues in this figure. Net issues, I'm talking about these red bars. Net issues are mostly negative. in every year. So it means that the cash raised by share issues was less than cash paid out to shareholders by repurchases of the previously outstanding shares. And debt issues, you can see sometimes a very small fraction or sometimes a substantial fraction of the total capital raised. Now, you understand that it seems internal financing is more convenient than external financing by stock and debt. And that's the reason probably firms have ended up using a more internally generated fund than externally generated fund. However, some observers worry that managers have an irrational or self-serving aversion to external financing. So we do not mean that managers are loafers. There are some good reasons for relying on internally generated funds. The cost of issuing new securities is avoided, for example, and moreover, the announcement of a new equity issue is usually a bad news for investors who worry that the decision signals lower future profits or higher risk. We will be discussing this issue in more detail later. This figure shows the aggregate balance sheet of all US manufacturing companies. If all these businesses were merged into a single gigantic firm, then this will be its balance sheet. Assets and liabilities in the table are entered in book value, that is accounting values. They do not generally the equity market values. The numbers, however, are instructive. For example, if you look at the firm had a long-term debt of 2014 $1 billion, whereas the firm has an equity of $3,973. Okay, so if you look at current liabilities, this is 1,802. Other long-term debt is 1,324. So this is the total long-term liabilities, 3,338, and the total liabilities and equity is $9,113 billion. Now, if we look at how much is the debt in the total capital, so this is our total asset, 9,113. This 1,802, if you can remember, is the current liability, and 3,338 is the long-term liability. So in the numerator we have total liability, and in the denominator we have total asset, or total liabilities and equity, and we can see that it's 56%. So it means that 56% of the total capital is coming from debt, or you can say that 56% of its asset is financed by debt. The ratio at the bottom of the slide shows long-term liabilities, and the long-term liabilities and equities, it's 34%. So 34% of the long-term liabilities and equities are financed by outside long-term liabilities. So this graph shows the trend of book and market debt ratios over the time from 1996 to 2013. So if you look at the starting point to the end point and the starting point to the end point, you see that there is a slight increase of the debt ratio over the time. However, there are some periods you can see where there was a general upward trend of using the debt, and however, there was a decline in this period. Also, at the inception of the global financial crisis, you can see the debt ratio increase. However, at the height of the crisis, it declined sharply. So you can see that how much debt ratio a firm uses sometimes is determined by the market factors. These are the holdings of corporate equities. That means, as I said, that the investors invest in equity issues issued by the firms. Now, the question may come, who are these investors? You can see that households invest 36.7% of the total equities. It means that in the total equity market, 36.7% of the investment comes from household. And a good portion is coming from the institutional investor, for example, pension funds, mutual funds, and insurance companies. So pension funds invest 15%, mutual fund invest 25%, insurance companies invest in 6%. And in the US market, about 16% of the investment is coming from the rest of the world. So this is the end of our discussion of the first part of the chapter, the patterns of corporate financing. Please watch the next video to see a discussion on the corporate securities. Thank you.